Futures market punters reckon the cash rate will be 3.5% by May next year. Now that doesn't mean it will be, but that's the forecast that has real money behind it. And one of the reasons they think borrowers will be able to withstand a cash rate of 3.5% is that the median mortgage buffer is now 21 months, which is to say the median borrower has got 21 months ahead of their repayments. And that's all well and good, except the 25th percentile has almost no buffer at all. And there are about 2.5 million families in that group. The median is irrelevant. Here's a graph of the last 7 housing downturns, the worst being more than 8% in 2017. Now this one is expected to be deeper than that because of how much debt there is. And this graph explains what happened to us. It shows the value of all residential land as a percentage of GDP against bank lending as a percentage of GDP. Now that tells you that house prices and debt took off when banks were deregulated in the 1980s and the shackles came off. And that's also when banks went from being mainly lenders to businesses, which employ people and create wealth, to being mainly lenders for housing, which doesn't, but it's safer and more profitable. The Australian dollar hardly moved today because the rate hike was fully expected. The local share market went up 1/3 of 1%, with gains by retailers and resources stocks offset by small declines by the banks. Wall Street was closed for Independence Day, while the markets in London and Tokyo went up and Shanghai went down, and commodity markets saw iron ore fall 2.5%, while oil, nickel and gold went up. And that's finance. Thanks for watching. You can check out more finance news by clicking there, and don't forget to click subscribe down there to get all the latest updates from ABC News.